All right, so in this video, I'm going to talk a little bit about the payback period and the discounted payback period. So the payback period is how long it takes to recover the initial investment. So it is a length of time. So it's telling you how long for me to get my money back from what I initially spent. So basically, in order to do this, you're going to create a table that's going to show the cumulative cash flow before and after each individual cash flow, and then you can determine when payback has been achieved. And so basically, you're calculating and showing, how long did it take for me to actually get the money back? So payback is ultimately measured in years, it's the length of time. And the shorter the period of time, the better. And really what that means is this is sort of connected with liquidity. So the faster I get the money back, the faster I can use that money for something else, which we ultimately like. So to illustrate this a little bit, let's take a look at a little example. So if I have a situation, let's say this is my little capital budgeting project, it's a 5-year project, and these are my cash flows. So at time 0 to start the project, initially I have a $100 expenditure that I'm going to have. So in order to calculate the payback period, basically what I'm going to do is I'm going to look at the beginning cash flow or beginning amount. So the beginning amount, then I'm going to look at the cash flow, then I'm going to look at the ending amount. Okay. It's the beginning amount, the cash flow, and the ending amount. And I'm going to put it in the years here. Okay. So at the start of the first year, I start off being down $100. So I'm down $100. And if we want to make this a little bit prettier, I suppose, we can actually kind of add a little bit of formatting there. Okay. So I start off the first year in the hole $100. Now, my cash flow for the first year is 20. So I'm going to put in $20 for my cash flow. Where I end the year then is going to be equal to negative 80, right? So I'm going to have negative $80. So I'm still in the hole 80 bucks, which that means that I'm going to start off in the hole by negative $80. Okay. My cash flow for the second year is 30. So I'm going to put that here in the middle. Okay. So now I'm going to end the second year. I'm still in the hole, but now I'm in the hole by $50. So I'm in the hole by $50. So that means I start the third year in the hole by $50. Okay. Well, year 3, I earned $30 that year too. So I'm going to have $30 for that. Whoops, this is a negative 50. Okay. So we're going to have $30 for that. Okay. So that means I'm going to end this year in the hole by $20. So I roll into year 4, and in year 4, I start off by being down by $20. My cash flow in year 4 is $50. So I end year 4 at positive $30. Okay. So if I look at this, what that means is at the end of year 3, I still was in the hole, but by the end of year 4, I actually am positive. So it took 3 full years and some part of the 4th year. So for my payback period, I got 3 years. Okay. The question then is how much more than that? So it's 3 years and some portion. So 3 point something. So what's the point something? So if it's 3 point something, what we're going to do is we're going to assume that I earned that $50 in year 4 evenly throughout the year. If I assumed I earned that evenly throughout the year, I needed 20 of it to get back to 0. So what I'm going to do is I'm going to take 2 over 5. Okay, so 2 over 5, or 20 over 50, right? So 20 over 50, 2 over 5. Well, if I calculate out 20 over 50, then that is 40% or 0.4. So I can actually just go ahead and calculate this out here. So what I would have is equal to 20 divided by 50. So I earned 50 throughout the year. 20 of it was what I needed to get back to 0. So 20 divided by 50, that's 0.4. I put those together, and my payback period is 3.4. And of course, Excel is trying to make that dollars, and it's not. So my payback period is 3.4 years. Okay, so it took 3.4 years for me to recover my original investment. So that would be how I would calculate the payback period. It's also worth noting if you wanted to, since you already have the cash flows here, you could actually do a cumulative line here below that and actually kind of keep track of where you are on a cumulative standpoint and see when you get back to 0. So you can actually do that here if you wanted to, or you can make the table. The basic idea is we're trying to quantify how long does it take for us to get back to 0. I kind of like the layout of this because it's a little bit clearer about what's going on and kind of how we get there. But ultimately, at the end of the day, we got to the number. In this case, it took 3.4 years to get back to 0. Now, how do we actually interpret that? What does this actually mean? Well, let's take a look at that. So we like shorter payback. So if it had been 2 years instead, that would have been better, right? Now we do have some problems associated with payback. So there should be a few things that should have made you sort of inherently nervous about this process. So the first one, if I come back to this, notice that I treated a dollar spent at time zero the same as a dollar spent that I received in year one, a dollar received in year two, three, four, and so forth. So I basically completely ignored time value of money, which is not good because one of the key ideas of finance here is that a dollar in a year in the future, or 10 years in the future, or 5 years in the future is not worth the same thing as a dollar today. So I completely ignored time value of money here, but that's what Payback does, right? So that's one criticism that we have for Payback, is that I've completely ignored time value of money. Now, the other thing that's worth noting is that I have also ignored cash flows occurring after the payback period. Now, to see that, let's go back to the example. What if this cash flow, instead of being $50, what if it was $5,000? Well, the project would clearly be much more interesting and much better looking. If I spent $100 in year one or time zero and I get a load more than I spent, my rate of return on investment would be drastically higher. This would be amazing. However, it wouldn't actually change the calculation of the payback. Payback would still be 3.4 years. So one of the criticisms of the payback calculation is it completely ignores anything that happens after payback has been achieved. So first off, payback ignores time value of money, so that's not great. Secondly, it ignores any cash flow that happens after payback's achieved. So I could have two projects with the same payback, and realistically, they could look very different in terms of their attractiveness, but payback wouldn't really pick up on that in certain cases. So those are some challenges associated with payback. Now, how do I decide what to do based on payback? Well, if the payback period is less than or equal to whatever the company standard is, we like the project. So if the company standard is, I got to get my money back in 4 years or less, and the example that I did at 3.4, that would be good. If the company standard is we have to get the money back in 2.5 years, well, in that project, we only get the money back after 3.4 years, that would be bad. So basically, you compare that payback period to whatever the threshold is, and that's how you're going to determine whether you would accept or reject based on payback. Now, if you're thinking about this, as I've noted, one of the big criticisms we have with payback is that I've completely ignored time value of money. I treated a dollar at time zero the same as a dollar in year one, the same as a dollar in year five. I treated all the dollars the same, completely ignored time value of money. That wasn't good. So to address that, we have discounted payback. So discounted payback is how long it takes the expected cash flows discounted by the risk-adjusted cost of capital to recover the original investment. So if we go back to the spreadsheet, basically what we're going to do is instead of using the raw cash flows here, what we could do is we could put a line of present values, calculate the present value of each cash flow here. All right. So I'd have to have a discount rate. So let's say my discount rate is 10%. Okay. So if my discount rate is 10%, I'm going to find the present value. So I do equals negative PV. My rate is going to be my 10%. I'll go ahead and make that an absolute reference. Then I'm going to put in the number of periods, which this is my number of periods. I don't have any payments. That would be if I had an annuity, which I don't. Then my future value is the $20, close parentheses. There's my present value. So I got present value of $18.18. Now that I've done that, I can drag that over. These are now my present values. And basically what we would do is we would follow the same kind of approach as we did for calculating payback, but instead of actually using the cash flows in this column, I would use the present values. So this first value would be 18.18, the second one would be 24.79, the third one would be 22.54, and so forth, right? So basically I would do the same general approach as with payback, but instead of using the cash flows, I'm going to look at the present values instead. And that brings up an important point. Notice how all of these present values are smaller than the original cash flows that are happening in the future, which makes sense. I've discounted, the value is smaller, hence discounting, right? So what that means then is if I have an initial cash outlay at time zero and then only positive cash flows after that, which is pretty typical in a capital budgeting scenario, then the present values are all going to be smaller than the raw values, the raw cash flows. And what that means is the discounted payback is going to be longer than the regular payback because I'm going to be using all of these smaller numbers to try to get back to my original investment. It actually brings up another possibility, and that is it's possible for a project to achieve payback, meaning that you get the money back if I just look at the raw dollar figures, but not to have a discounted payback because by the time I found present values, it's possible that the present values add up less than the original investment. So it's possible for a project to have actually a payback period where they get the money back before the project is over, but it could also, in some cases, be a situation in which it does not have a discounted payback, because if the discount rate is high enough and the cash flows are small enough, once I factored in present value, I might never get my money back. Obviously, that wouldn't be very attractive, but it is possible you could run into that situation where on a discounted basis, so if I'm using the present values, it's possible the project never actually gets the money back. So that can occur. Now, ultimately, we still have that other problem remaining from the payback period, which is the discounted payback ignores any cash flows that happen after the discounted payback period. So in that example that I was just using, let's suppose discounted payback occurred before the end of the project. Any cash flows happening after that, maybe let's say the project was longer than 5 years. Let's say it went on to 10 years. Cash flows out into the future in year 10 would not be factored in. So any cash flows that happen after the discounted payback has been achieved, again, they're ignored. So that's kind of something to watch out for. And as I noted, it is possible for a project to have a payback period where on a just raw cash flow value basis, the project gets its money back. But it's also possible that in that scenario, it might not have a discounted payback if, once I factored in time value of money, the present values are too low to actually get the money back in terms of value today. So that is a possible outcome for discounted payback. Hopefully this little video about discounted payback and payback has been helpful. Thank you so much for watching, and have a great day.